The Upside Gap 2 Crows pattern is a unique formation that signals a potential bearish reversal in the market. This pattern is characterized by a gap up from a long white candle to a small black candle, followed by a larger black candle that opens within the body of the first black candle and closes within the body of the long white candle, but does not close the gap. It is important for traders to not only recognize this pattern, but also be aware of similar patterns that indicate bearish reversals under different market conditions. Two such patterns are the evening star and dark cloud cover. The evening star pattern is a 3-candlestick formation that typically occurs at the end of an uptrend. It begins with a long white candle signaling continued bullish sentiment. This is followed by a small-bodied candle, white or black, that gaps above the first candle, indicating deceleration in buying pressure. The third candle is a long black one that opens below the second candle and closes well into the body of the first candle, marking the start of a bearish reversal. On the other hand, the dark cloud cover pattern appears during an uptrend and is comprised of 2 candlesticks. The first is a long white candle, reflective of the prevailing bullish market. The second is a black candle that opens at a new high and then closes below the midpoint of the body of the first candle, indicating a shift in momentum from buyers to sellers. Understanding these variations, the Upside Gap 2 Crows, the Evening Star, and the Dark Cloud Cover equips traders with valuable insights into market sentiment shifts under different conditions. Recognizing these patterns and the conditions under which they appear enhances a trader's ability to make informed decisions by accurately interpreting potential market reversals. Continuation patterns in the financial market serve as indicators that an existing trend is likely to persist. Among these patterns, the Upside Tasuki Gap stands out as a specific formation signaling the continuation of a bullish trend. This pattern emerges in the midst of a price upswing, showcasing the ongoing dominance of buyers within the market. It is identified through a distinct gap observed between 2 candlesticks, where the latter does not fully close the gap created by its predecessor, further reinforcing the strength of the current uptrend. In essence, the Upside Tasuki Gap embodies the optimism and buying pressure that propels the price higher, distinguishing it as a critical pattern for investors and analysts looking to anticipate future market movements based on the prevailing bullish momentum. The Upside Tasuki Gap is a bullish continuation pattern observed in candlestick charting. This pattern comprises 3 key candles. The first candle is large and white or green, signaling a strong uptrend. Following this, there is a gap up, leading to the second candle. This second candle can be of any color, smaller than the first, and it continues to advance the uptrend but does not need to surpass the high of the first candle. The crucial aspect here is the gap between the first and second candles, representing continued buying interest. The third candle in this pattern is where the unique characteristic of the Upside Tasuki Gap comes into play. It is a black or red candle that opens within the body of the second candle. Critically, it closes within the gap between the first and second candles. This means the third candle moves downward but does not close the gap entirely. It only partially covers it. This action signals that while there might be some selling pressure or profit-taking, the overall bullish sentiment in the market is not significantly damaged. The presence of the Upside Tasuki Gap suggests that despite a brief interlude of selling, the bullish trend is strong enough to continue. Investors and traders often view this pattern as an opportunity to join the uptrend, expecting the price to advance further. The Upside Tasuki Gap is a pattern that emerges on candlestick charts, reflecting an optimistic sentiment among market participants. It typically appears during an uptrend, characterized initially by a gap between two green candles. These candles signify strong buying interest as buyers are willing to purchase at higher prices, pushing the market upward. Subsequently, a smaller black candle appears, which does not fill the gap created earlier. This black candle represents a brief moment of selling pressure or profit-taking, where sellers momentarily take control and prices dip. However, the crucial point about this pattern is that the selling pressure is temporary and not strong enough to reverse the trend. The gap left by the initial surge remains unfilled, indicating that the overall sentiment in the market is still decidedly bullish. Buyers quickly regain the upper hand, seen in the inability of the black candle to push back down through the gap. This suggests that there is still a strong demand for the asset, and many are optimistic about further price increases. The existence of the gap, along with the swift return to buying, demonstrates a clear confidence among investors that the uptrend is likely to continue. In essence, the Upside Tasuki Gap acts as a visual metaphor for the market's mood. Even when faced with moments of doubt or minor setbacks, the prevailing attitude remains positive. The market's capacity to maintain its upward momentum, despite the temporary dips reflected in the black candle, underscores a robust bullish sentiment. This pattern reassures investors of sustained interest and demand, suggesting that prices may continue to rise as buying pressure resumes control. The Upside Tasuki Gap is a pattern observed in financial charts that signals the likelihood of an ongoing uptrend continuing. This pattern emerges within a well-established uptrend, and it is categorized as a bullish continuation pattern. To understand the Upside Tasuki Gap, let us paint a picture of what this looks like on a chart. Imagine an uptrend where each consecutive candlestick closes higher than the one before. During this uptrend, a gap forms between two candlesticks where the second candlestick opens higher than the first one closes, creating a gap with no trading activity between their price ranges. This gap is a sign of strong buying pressure, indicating that buyers are in control and pushing the price upwards. Following this gap, another candlestick appears. This one opens within the body of the gap and closes within the gap, but does not fully close it. This means that while there was some selling pressure, it was not enough to reverse the trend. Instead, the prevailing uptrend is expected to continue. By signaling that an uptrend is likely to continue, the Upside Tasuki Gap helps traders and investors to make informed decisions about staying in their positions or entering new ones in anticipation of further price increases. This pattern underscores the importance of recognizing and understanding chart patterns for estimating future market movements and aligns with the broader strategy of following trends for trading and investment decisions. In the study of the Upside Tasuki Gap, a bullish continuation pattern, volume plays a crucial role in confirming the trend. Ideally, volume should increase during the formation of the first candle, indicating strong buying interest. It is essential for this increased volume to persist throughout the formation of the pattern. This sustained high volume is a key factor in confirming the bullish sentiment among traders, suggesting a strong likelihood that the upward trend will continue. Following the completion of the Upside Tasuki Gap pattern, additional bullish signals can further confirm the trend's continuation. These signals might come in various forms, such as a positive earnings report for a company or broader economic news that encourages investing. The combination of sustained high volume during the pattern's formation and subsequent bullish signals can provide a solid foundation for traders' confidence in the continuing uptrend. Understanding this concept requires recognizing the significance of volume as a measure of market sentiment. High trading volume during a pattern's formation signals strong participation and agreement among traders on the direction of the market. Thus, when analyzing chart patterns like the Upside Tasuki Gap, paying attention to volume can offer critical insights into the strength and reliability of the trend at hand. The Upside Tasuki Gap is considered a strong indicator of a bullish continuation pattern, suggesting that the upward trend in the market might persist. It occurs when there is a gap in the price movement that aligns with the prevailing trend, essentially signaling that buyers are maintaining control and pushing prices higher. Despite its reliability, it is important to note that the Upside Tasuki Gap, like any single technical analysis tool, should not be solely relied upon to make investment decisions. Its predictive power can be significantly enhanced when it is used in conjunction with other technical analysis tools and indicators. For example, combining it with volume analysis, moving averages, and other pattern recognition strategies can offer a more holistic view of market conditions. This layered approach to analysis helps confirm the signal provided by the Upside Tasuki Gap and mitigate the risk of false signals. In essence, while the Upside Tasuki Gap serves as a compelling indicator for bullish continuation, incorporating additional tools into one's analysis helps create a more robust and reliable investment strategy. This integrative approach allows investors to navigate the complexity of the markets with greater confidence and precision. To combine the Upside Tasuki Gap pattern with other technical analysis tools effectively, one can follow a structured approach that enhances the accuracy of identifying bullish continuation signals. Firstly, integrate the Relative Strength Index, commonly known as RSI, to spot overbought conditions. While an overbought RSI typically suggests a potential pullback in the context of a bullish Upside Tasuki Gap, it can indicate sustained bullish momentum if it remains above the threshold without showing signs of reversing sharply. Secondly, the Moving Average Convergence Divergence, or MACD, is instrumental in confirming the momentum. When the MACD line crosses above the signal line, it reinforces the bullish momentum suggested by the Upside Tasuki Gap pattern. It is crucial to look for this confirmation shortly after the pattern occurs, as it signifies strong buying pressure. Lastly, support and resistance levels provide a critical context for the pattern's occurrence. Identifying these levels before the appearance of an Upside Tasuki Gap can offer insights into potential areas where the price might consolidate or face pullbacks. If the pattern forms near a key support level, it may suggest a stronger conviction among buyers to push the price higher. Conversely, if it appears near resistance, traders should tread cautiously and seek additional bullish signals before acting. In summary, combining the Upside Tasuki Gap with RSI, MACD, and an understanding of support and resistance levels offers a multi-dimensional analysis framework. This approach allows traders to assess the market context more effectively, enhancing their ability to make informed trading decisions based on a synergistic use of technical analysis tools. When analyzing the Upside Tasuki Gap pattern, it is essential to be cautious of common pitfalls that could lead to incorrect interpretations of the market. One such mistake is misinterpreting this pattern as a bearish signal if the third candlestick completely closes the gap. The Upside Tasuki Gap is identified by a gap between the first and second bullish candles, followed by a bearish candle that fails to close the gap. It is crucial to remember that if the third candle completely closes the gap, the pattern loses its bullish significance. Another common mistake is acting on the Upside Tasuki Gap pattern without waiting for additional confirmation signals. As with all technical analysis patterns, the Upside Tasuki Gap is more reliable when confirmed by other indicators or chart patterns. Acting prematurely based on this pattern alone could lead to misjudgments about future price movements. To avoid these common misinterpretations, thorough analysis and patience are key. Look for further signs of bullish continuation beyond the initial pattern and approach each signal with a comprehensive analysis of market conditions to make informed trading decisions. To capitalize on the Upside Tasuki Gap, a bullish continuation pattern, traders can adopt a strategic approach to guide their trading decisions effectively. Once the pattern is confirmed, which indicates a potential continuation of the uptrend, the ideal entry point is immediately after this confirmation. This is because the pattern suggests that the bullish sentiment remains strong and prices may continue to rise. For setting exit points, traders should look towards subsequent resistance levels or establish a predefined profit target. Setting a profit target involves determining an optimal price level at which to sell the asset for a profit based on historical data and the trader's risk tolerance. Observing resistance levels can help identify potential points where the price may face difficulties in climbing higher, making them ideal spots to take profits. Equally important is the practice of setting stop-loss orders to manage risk effectively. A stop-loss order is an order placed with a broker to buy or sell once the asset reaches a certain price. It is designed to limit an investor's loss on a position. For the Upside Tasuki Gap strategy, placing a stop-loss order just below the pattern's formation can help protect against unexpected reversals in the market trend. This risk management tool ensures that losses are kept to a minimum, allowing traders to preserve their capital for future opportunities. By integrating these strategies, traders can leverage the Upside Tasuki Gap to make informed and strategic trading decisions. This approach not only maximizes potential profits by entering the market at opportune times, but also minimizes risks through carefully planned exit strategies and the prudent use of stop-loss orders.